I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast Show, and today is July 13th.
And today we're going to talk about a couple great things. Number one, where are mortgage rates today? Fed's predictions for the next 12 months, what are they? And the inflation report came out yesterday. What did they say? Let's get into it.
If you like what we're doing, be sure to subscribe, comment, and like. You can always email us, chat here in the comment section, and subscribe. And remember, this is for informational purposes only. This is not financial advice. All right. Now, the Mortgage News Daily comes up with the survey of all or the majority of banks in the country. Where are the
entire country? This is not just the Mortgage Brothers.
Yeah, this is just a survey, and it shows where these rate sheets are looking for where the quotes are coming in at. We see the 30-year fix at 6.96. The 15-year fixed conventional loan at 6.38.
The 30-year FHA and the 30-year VA, same, 6.62.
And remember, this is the national average. The Mortgage Brothers, if you have a scenario that you want us to quote for you for a purchase or refinance, be sure to let us know. We'll give you our personalized rates for you. And the big news yesterday on July 12th was the inflation report came out, and it is constantly improving. And this is good for interest rates. We went from a 4% last month to now 3% on the main inflation. Now, core inflation is the inflation without food and gas, and that went from 5.3 last month to 4.8.
And one of the really important things is not only did it go down, but it went down compared to what they were forecasting. The forecast was already that it was going to come down. Now what they were hoping for is please, please, please let it come down a little bit more, which it did.
Yes, and this has resulted in an improvement in the 10-year yield. And the 10-year yield is what we look at when we want to see where the mortgage rates are going to go. We always look at where the 10-year yield is going.
It's kind of like the grandfather bond. They don't look at the 2-year or the 3-year. If there's a 3-year or 3-year.
Yeah.
5-year. They go to the 10-year.
And we see that on June 29th, well, actually, all for the last 2 weeks, we have seen rates on a tear. They have just constantly gotten worse and worse. And then by worse, I mean by going up, right? I mean, rates are becoming more expensive. And they broke out of this resistance. And I've been talking about resistance here on using this chart for many months.
You like that because it sounds like Star Wars or something.
Yeah,
resistance.
This line right here on June 29th, it broke out. There was downward trend since November of 2022. And it broke out of this and basically created a new resistance here, which was it was the all-time high. It was the high back in March, early March.
And basically the reason why it broke out was if you look at our interest rate slide, going all the way back to October, you can see here that inflation was starting to get under control. The Feds are doing, their little, tricks in order to get inflation down. It's working. And all of a sudden, positive news came out. It's like, oh, well, we were expecting positive news, but it was too positive. And more too positive news came out. And it broke above that line. Well, today, they finally said, okay, we do think that the inflationary workings that the Feds are doing is working a little bit better than we thought, which is driving that bond down.
And so we will either see the 10-year, again, and when I say the 10-year, I also mean the mortgage rates, it's close. It'll either come through and break below this support line right here or go back up and break this or trade in this range. But I think Tom and I both believe that this will trend down and break. We think that it will likely be doing that here in the near future.
And we've said this not recently, but good news is bad news. I don't know when we said that before this last year, but the worse the news is, the better it is for this bond, which sounds really quirky and wrong, but that's just the way it is. So if we don't get bad news and we start to see, more economic data, more positive, more spending, more back to school, et cetera, then it could go back up to that next resistance line.
Yeah. And then this is the CME report showing where the Fed rate is today, but it also forecasts the next meeting. So the next meeting is July 26th. So that's coming up here in a couple weeks. And there is today, the interest rate for the Fed is 5.25%. Now, in 2 weeks, there's a 92% chance, according to the futures traders, that there will be a 0.25% hike. And then it looks like it's going to be pretty stable according to the way that now, and if you've been following this channel, you've noticed this chart updates a lot, and it does. It updates every day. But what we have noticed is that it will now. The only time we really see the forecast for an improvement is pushed back to March of 2024, and then of course just every month or every meeting thereafter, we see the Fed rate improving.
And remember that when we say 92% chance that it goes to 550, these future bettors are already priced that into the bond. So when it does go to 5.50, 5.50, it's not that rates will change. They're already assuming it's going to be that.
That's right. That's right. And then we have this cool little calculation that we've done based off of this is the same Fed meetings that we showed on the other slide, but if the expected Fed rate is 5.5 in the July 26, of course rates today, let's just say that they are 6.75%. If it's unchanged, this theoretically would be from July, our next meeting, and let's just say March. We start maybe seeing them to 6.5, and all the way through December 18th of 2024. Maybe we see the mortgage rates at 5%.
So basically take the expected funds, Fed funds rate and just add 1.25. That's kind of what we say. It shouldn't systematically always be that, but if you look at these numbers, that's basically what we're saying.
That's right. And if you like what we're doing, again, be sure to subscribe, comment, like, call us. We'll be happy to help you with your scenario. Tom and I are mortgage brokers right here in Phoenix, Arizona. Again, this is mortgage stuff. This is what we do. We'd be happy to help.
All right. Hey, thanks, folks.
Take care.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.